So in this video, we are going to talk about capital structure. So should the company raise equity or debt to finance its projects? Is raising equity or debt will affect the value of the company? So this is the main question we are going to look at this chapter. We'll consider a few points regarding capital structure theories. A company should seek to minimize its weighted average cost of capital. In short, we will refer it to as WACC. By doing so, it minimizes its cost of funds. The WACC is an average cost of all different sources of finance that a company uses. By changing the proportion of each type of finance, a company can alter its WACC. By changing WACC, it will result in a changed valuation for the business. So what is WACC in the first case? So a company uses debt, equity, and preference shares, and each of this has a kind of a cost, and each cost has to be combined together, and we get an average cost for all the sources of funds. Okay, so the lower the cost, it's better for the company. So that is what we refer to as WACC. So we'll see what is the relationship between the weighted average cost of capital and the value of a business. The value of the business is the cash flow of the business discounted at the WACC. So this is similar to a NPV problem where we have the cash flows and the discounted cash flows at a discounting factor of WACC results in the value of a business. Okay, so that's how it works. Similar to an NPV, we can also value a company. If the WACC is higher, it leads to lower value of the business. So WACC, the weighted average cost of capital, and the value of the business are inverse in nature. If the WACC is lower, it leads to a higher valuation for the same business. Hence, WACC and value of the business are inverse in nature. So we can look at this table to find out the relationship between the WACC and the value of a company. So the WACC can also be used as a discount factor percentage to value a business. For example, here we'll take a company. It has a cash flow for 3 years of 100 rupees each year. And we'll assume that the company has a weighted average cost of capital of 20%. So for the first year, it's this number, second year, this number, and third year is this number, is the discount factor. And we get a value for this company at 210 rupees if discounted at 20%. So if we are going to use 10%, if you could reduce our WACC to 10%, then the value of our company comes to 248.6. If you see, the cash flow has not changed between this company. The same company is used, the same cash flow is used, but the discount factor alone changes. This has resulted in an increase of the value of the company. So by reducing the WACC from 20% to 10%, it has led to an increase in the company's value by 38.1. So that is the relationship between WACC and the value of the company. So how can we reduce the WACC? To reduce the weighted average cost of capital, the company should actually raise more debt, because debt is actually cheaper than equity. So equity, this would result in a lower risk for the company, and it will also give you tax benefit because the interest is a expense, and expenses reduces your tax. So having debt is actually a cheaper form of cost of capital. But increasing the debt level makes a company more risky. So higher fixed interest payment and higher chances of bankruptcy. So up to a level you can raise debt, but beyond a level it becomes a problem where we have to pay more interest, and we also have a high chance of getting bankrupt. Okay, so these are the problems using debt. Okay, so we'll look at this question. Which one of the following factors might cause a firm to increase the debt in its financial structure? So which factors leads to an increase in the debt? Okay, what motivates a company to raise more debt? So an increase in the corporate tax rate, yes, of course this will do, because the higher the tax rate, it will give us more interest tax benefit. Increase the economic uncertainty, no. An increase in the PE ratio, this is only applicable for a share. A decrease in the interest coverage ratio, no, this will actually demotivate the company to raise more debt. So the answer should be A. So that's how the question works. So if you want to find out why interest helps in reducing the tax, we can do it like this. Assume a company makes a profit. We'll take it as a profit before interest and tax. The company has 100 rupees. The interest is 0. They don't pay any interest. The tax is at 30%. So the company should pay 30% tax. So the profit after tax comes to 70 rupees. Sorry, it comes to 70 rupees. Okay. The same company goes for debt. If they borrow debt, they have to pay interest. Assume that they are paying 30 rupees as debt interest. So now the calculation of tax now changes. So tax will be computed not on the 100, it will be computed on the 70 into 30%. So that gives you 21. Okay, so 21 would be the interest, 49. So the profit after tax comes to 49. So where does our tax get reduced? Okay, so if you could look at here, our tax gets effectively reduced. Okay, so earlier we paid a tax of 30, but now we only pay a tax of 21. So don't look at the PAT. Okay, don't look at the PAT. That is not our consideration. Interest leads to lowering of paying tax. Okay, so even though the 30% is constant, we pay only 21 as our tax. Okay, if we have interest. So that's how that is the benefit which interest gives us. So we will move on to the capital structure theories. So capital structure theories are of three types. So the first one is traditional view. The second one is Modigliani and Miller without tax benefit view. And the third one is Modigliani and Miller with tax benefit. So we have three theories. So whenever you get a question regarding whether a company should go for raising debt or equity, you should use these theories to answer your question. And each of these theories give a very conflicting result. So one of the theories says you have to go for debt. One theory says don't go for debt. One theory says don't worry about your capital structure at all. So each theory gives their own views. But in your answer, if they ask you any specific view, you can explain that. If they ask you a general view, you have to explain all the three. Okay, so that's how it works. So we'll start from the traditional view. Under the traditional theory of cost of capital, the WACC declines initially as gearing increases, but then rises as gearing increases further. Okay, so here it says that the weighted average cost of capital falls as your debt increases, and at one point of time, as your debt keeps on increasing, your WACC also increases. So we look at this picture. In this picture, you can see it like this. So this is gearing. Okay, as gearing rises, so as we can put like this, this is gearing we'll put. As gearing rises, the WACC falls to a point. Okay, to a point, and as the gearing still, as the debt still rises, okay, that leads to the WACC increasing. So that is an optimal point. So this is the optimal point. The P refers to the optimal point. The optimal point is the optimal capital structure. That is, at that point, the WACC is the lowest. So the companies should aim for this combination of capital structure. So in reality, what is the difficult is we can't find out the optimal structure exactly and all. So approximately we can find out. So once we have found out the optimal point, the company has to stick on with that optimal point. That is, assume that at 40% of debt and 60% of equity, the WACC is the lowest, means the company, once it has found it, the company has to fix this ratio for a long period. Okay, so this theory assumes there is an optimal capital structure point where the WACC is lowest and the company should aim for that structure only. So this is another chart regarding the traditional view. So here we have KE, KO and KD. KD refers to cost of debt, KE refers to the cost of equity, and K0 refers to overall cost. Okay, overall cost or the WACC. Okay, so that's what it is indicating. So we'll move on to the assumptions of this theory. As the level of gearing increases, so this is the level of gearing. Okay, this is the level of gearing. As the level of gearing increases, the cost of debt remains unchanged. See, the cost is not increasing at all. It's like very stable. So as the level of gearing increases, the cost remains the same up to a certain level of gearing. Beyond this level, the cost of debt will increase. So beyond, if you see this level, the cost of debt is actually increasing. Okay, so up to a point it's constant. Beyond that point of gearing, the cost of debt rises. The cost of equity rises as the level of gearing increases. Okay, and the financial risk increases. So here the equity shareholders feel that debt is always a kind of a risky thing. So okay, whenever the gearing is increasing, the cost of equity is actually keeps on increasing. You can see it here in this line. It's keep on increasing. The WACC falls initially as the proportion of debt to capital increases and then increases as the rising cost of equity and debt becomes more significant. So now they are going to speak about the KO. So as the level of gearing keeps on increasing, the WACC actually falls down. This is because the KD is much more lower than the KE. Okay, so what happens is it keeps falling, but at some point of time, okay, as both the KE and the KD is rising, there's no other option for KO, but it also rises. Why does it rise? Because KO is the average of it is the weighted average cost of capital. Okay, so weighted average cost of capital is something like KE plus KD and the average out of it. We can't say it's divided by 2, but roughly it's an average. So up to a point it falls and beyond that point it rises. So this is the traditional view of theory. Okay, so this point is the optimal point. So again here they have marked that as P. So this is the optimal capital structure. Okay, so that's about the traditional view. The optimum level of gearing is where the company's WACC is minimized. So that's about the optimal capital structure. So we'll move on to the next view. It's called as the Modigliani-Miller. So hereafter we'll refer it to as approach without tax. So here what they tell is, they say that whether you have equity finance, debt finance, or whatever you are a company, it does not matter at all. Whether you have 100% debt or 100% equity, that doesn't matter at all. What matters is the value that the company is generating. Okay, so every company has its own ability to generate profits, and they take a particular amount of risk to generate that profit. Okay, so what happens is, we can have this table to explain it better. Assume there's a company, they take a particular amount of risk. For that risk, the weighted average cost of capital comes to 10%. Okay, so this company takes a moderate risk and their discount factor or WACC is 10%. So this is the value of the company. The same company wants to take a higher risk. Okay, the same company wants to take a higher risk, and what happens is they create something like this. So the company wants to take more risk, so every year they are going to get another additional 15 rupees when compared to the last project. Okay, so company A with low risk projects has this kind of a structure. The same company wants to take a high risk project, so as the company takes a high risk projects, have a higher discount factor because it has higher risk. They have to be valued at a higher WACC or a higher discount factor. So again we discount it, again we add it. What happens is it comes to 248. If you look at both these numbers, both this number and this number are same, right? How did we arrive at the same number? It's because I calculated it, so it will be the same. Okay, but the theory states that the number would be same. Okay, how does he argue like that? I'm not like sure. He has some research findings, but in order to write in an exam, this is what the concept is. So how did we arrive at 248? What the theory says is the value of the company remains same irrespective of whether you are in a low risk project or a high risk project. The value of the company remains same. Okay, What changes is the more the risk you take, your WACC on loan changes. Okay, so your company's cash flow will be discounted at an appropriate rate and it will come to the same value. So it simply says that whether you have equity or you have debt or you have both does not matter. Okay, does not matter, because your value of the company is going to be the value of the company is going to be same. So don't worry about capital structure. Okay, so don't worry about your capital structure. What you should worry about is how can you increase your cash flow, okay, without taking more risk. So that's what you have to worry about. So this is what the chart which Modigliani and Miller theory says without tax. So whether you have KD or you have KE, that doesn't matter, because your KO is always constant. Whether you see for any point of gearing, okay, whatever gearing you have, your KO does not change at all. Your KO is constant. This is what approach says without tax. So the same approach with tax is totally changing. So in 1963, Modigliani and Miller modified their theory to admit the tax relief on interest payments. So now they feel that if interest acts as tax benefit, then that cheaper cost of funding should be used heavily when compared to equity. So they feel that that should actually lower the WACC. We put like this: KD is equal to cheap, hence have more debt. Okay, hence have more debt. So that's what this second theory states. The savings arising from tax relief on debt interest are the tax shield. That's a tax benefit. However, whereas the traditional approach to gearing and WACC is that there is an optimal level of gearing where WACC is minimized, took a different view. They say that there is no optimal capital structure and all. They argue the WACC continues to fall, okay, up to 100% of gearing. It means your company can have 100% of debt, that is 0% of equity. That is the optimal capital point which suggests. Okay, so that in reality, this is how it works. He says KD after tax is so cheap. Okay, it's so cheap. KE can be higher, that doesn't matter. But as KD after tax is so cheap, the more we borrow, for example, if we borrow even up to 100%, the K0 would actually go down. That is, have 100% debt. That's what his suggestion is. The suggestion seems to be very foolish. Okay, so what happens is, this is the argument that people are giving in rebuttal to approach with tax benefit. This suggests that the company should have a capital structure made up of entirely debt. But what's the problem of having entire debt? This does not happen in practice due to the existence of other market imperfections which undermine the tax advantage of debt. Okay, so they says that this does not happen in a reality. It's because of this actually leads to bankruptcy, restrictions on existing debt holders. So existing debt holders will say don't go for 100% and all. At 50% itself they'll become panicked, so they will stop the company from raising more debt. No profit to benefit from tax benefit of interest. So in order to get benefit from tax, we should have at least a profit, then only tax is levied. If there's no tax at all, then even if we have interest, it will not benefit us at all. So that's about the theory. What we'll do now is we'll summarize all these theories put together. So we'll have it like this. Traditional theory says the WACC is U-shaped, okay, and there's an optimal point. At that optimal point, WACC is minimized. Okay, our job is to find out that optimal point, okay, and have a financing structure in relation to the optimal point. Approach with no tax benefit is that cheaper debt is very good, but at the same point of time it increases the KE. What happens is WACC is always constant, so don't worry about the overall cost of capital or WACC. So choice of fund is irrelevant. Use anything. You can have debt or equity or both or anything you can have. The same approach with tax says that debt is very cheap, so WACC will fall, so have as much as debt. So we can summarize like this. Traditional theory says that there is an optimal point of debit and equity. The next one says is it can be debt or equity or both. Okay, but the last one says is have only debt. That's a good thing. So we'll move on to the pecking order theory. Okay, that is the fourth kind of theory, which is like very different and very sensible also. So we'll move on to that theory, pecking order theory. Pecking order theory has been developed as an alternative to traditional theory. So this theory is based on the view that companies will not seek to minimize their WACC. Okay, it's not that the job of a company is not to minimize the WACC, but what they do is they try to finance any project based upon the preference. So there is a particular order in which companies raise finance. So it's not about the optimal theory or optimal point. They raise according to the kind of a preference. So what is a preference? Pecking order theory states that firms will prefer retained earnings to any other source of finance, and then they will go for debt, and lastly they go for equity. So this is the order in which companies raise their capital. So they first choose retained earnings, then go for debt issue, then they go for convertible debt, then they go for preference shares, then issue of new equity. Researchers found this model through practical observation of what companies do. This is what companies do in reality. They don't try to find out the optimal capital structure and then raise a particular debt or equity. In reality, this is how companies raise their finance. So it's much more realistic in nature. So why do companies follow this pecking order? It is easier to use retained earnings than obtaining external finance. This is because the money is already in hand, so they can easily use it. There is no issue cost involved in retained earnings. It's simply used. Investors usually, any investor in a company usually prefer debt when compared to equity. So it's easier to collect money through debt. Some managers believe debt issues have a better signaling effect than equity. Okay, there's a signaling effect where if a company is issuing debt, it seems to be that the company is like very strong. They are very confident in paying the interest, and they will they are like very sure about what they are doing. Okay, than equity issues, because the market believes that managers are better informed about the shares true worth than the market itself. So assume that the shares are already trading at 100 rupees. Okay, so this is the current market price, but the intrinsic value of the company is 200 rupees. So will the company go for a share issue? Means the company will not, because if they issue, they'll only get 100, but the realistic value of the company itself is 200, so they will not go for equity issue. So when will they go for equity issue? Only when the current market price is above the intrinsic value. For example, it's at 300 rupees, then they go for issual of shares, because then only it benefits the company. So companies usually go for debt because it's easier. Okay, it also signals that they are confident, and it also signals that the company, this share price is way below its intrinsic value. Their view is the market will interpret debt issues as a sign of confidence. Just now we've discussed this, that businesses are confident of making sufficient profit to fulfill their obligations on debt, and that they believe that the shares are undervalued. Okay, the shares are undervalued, so the company will not issue shares if the shares are trading at 100 rupees. They'll issue only when the shares are trading at 300 rupees. So I think you got a good idea about what is pecking order theory. So we'll have a quiz. Which capital structure theory suggests that the WACC will initially decrease, reach a minimum, and then increase? Which one tells it? I think it's B. Let's see the answer. It's B. We have another question. This question has appeared in December 2014. Which of the following statement is correct? A bonus issue can be used to raise new equity finance. The answer is no. We won't get any money inside the company. A share repurchase scheme can increase both EPS and gearing. It can increase the EPS. Can it increase the debit equity ratio? Okay, that we have to work out. So if a company has 100 by 100 as debit equity, then the answer is 1. If we reduce the equity by 80 rupees, then the answer becomes 1.25. So it increases the gearing. I think B seems to be right, but we'll check C and D also. Argued that the financing decision is more important than the dividend decision. No, he says this is wrong. They are not worried about the financing at all. So that's wrong. And that too, the question is not clear whether it's with tax or without tax. But either way, says that financing is useless and dividend decision is useless. Okay. Shareholders have the power to increase dividends at annual general meetings. Shareholders have the power actually to decrease the dividend, but they do not have the power to increase the dividend. Okay, so keep this in mind. So both C and D are wrong. So the answer should be B. So the answer is B. Okay, so we'll move on to the topic called as gearing and re-gearing. Okay, company A is in supermarket business and wants to enter into construction business, but will not change the capital structure. So company A has two risks. One is business risk and the other one is financial risk. So company A wants to enter into the construction business. So we have to look also in the construction business. So construction business company B also has two kinds of risk. One is business risk and financial risk. Okay. To compute the discount factor for company A, supermarket company, for entering into construction business, we have to find the beta. But the beta has to be recomputed. Okay, we can't use the discount factor of A or company B. Why? We'll check in the next one. Why can't we use the discount factor of company A and company B also for valuing this new thing? See, what happens is we need to enter into the business risk of company B, right? So this, we don't need the business risk of supermarket. That's like unnecessary. And we are going to use our own capital structure. So financial risk is going to remain the same. But for company B, we don't need financial risk because financial risk of our company is what is required. But we need a business risk of that company. So we are going to use the financial capital structure of company A and the business risk of construction company. So what happens is we have to create a new beta, that is company A entering into construction business. So the financial risk of supermarket will fall down and the business risk of construction company has to come together. This will now create a new beta. So to work out this as a problem, we need ungearing and regearing. So these are the formulas uh, for ungearing and regearing. Okay, so we'll work out this as a problem later. So you can just go through the formulas here. Okay, so these are the past exam questions that have been asked. So you can, the J refers to June and the D refers to December. The numbers actually refers to the year 2013, 2015, like that. So you can see like how many times questions from capital structure has appeared in the previous examinations. So thank you very much for watching this video. We'll meet in the next video.